Hello everyone, let's do a preparation of a statement of cash flows using the indirect method for a company called Midling Car Audio. And because Midling is going to use this indirect method in their operating section, they are going to essentially adjust their net income to the cash that has been provided by their operating activities. To do this, they would need a whole bunch of information. They would need to have their last income statement to find their net income and all of the gains and non-cash expenditures that would be used to make the statement of cash flows. They would need to make adjustments to their amount of net income to get it to cash provided by operating activities by using the change that they would report in their balance sheet over the last two periods. Well, instead of having a mountain of information, a bunch of financials to look at for the ease of students, I have compiled all the necessary information into a table for you. So before we even get started filling in the statement of cash flows, let's determine what our change was in our current asset and current liability accounts, as well as what section, operating, investing, financing, non-cash, we should be reporting all of these different listed items in. Starting up here, Midling had $64,600 worth of cash on its books at the end of 2018. They had $20,000 on their books at the end of the prior period. That is a total of $44,600 worth of increase they had to cash overall. And this number, I'm going to highlight and make yellow because it's incredibly important, is our answer for the period. So we know the whole time that we're working on the statement of cash flows, the ultimate number we're working towards is an increase of $44,600 in cash. What happened to our other current asset accounts? Well, we had accounts receivable of $20,000 at the end of the 2018 year, which is down from the $28,000 we reported the year prior in 2017. The amount of decrease that we had to AR was $8,000. For inventory, we're reporting $36,000 at the end of the current year. We reported $35,000 at the end of the prior year of inventory. That is an increase of $1,000. And for supplies, we are reporting $11,000 of supplies on hand at the end of 2018, which is an increase of $2,000 over the $9,000 we reported at the end of 2017. So we have our changes in our current assets. Let's go through and find our changes to our current liabilities. We're reporting $41,000 of accounts payable on our balance sheet at the end of 2018. On 2017's balance sheet, we reported $36,500 worth of accounts payable. So overall, accounts payable increased by $4,500 from the prior period to the current period. Accrued liabilities, things like salaries payable, interest payable, utilities payable, etc., are $9,000 on our current balance sheet. We reported $10,500 worth of accrued liabilities at the end of the prior period. That means that Midling Car Audio's accrued liabilities decreased by $1,500 from the prior period to the current period. And for unearned revenue, we are currently reporting $1,200 of unearned revenue on our books against the $800 that we reported last time, which means unearned revenue has increased by $400. And we're going to use these eventually in the adjustment section to our net income. But let's figure out what section the rest of these items go in. The first thing we have is our payment of cash dividends. Well, cash dividends is a withdrawal account, and like all withdrawal accounts, it is going to be a necessary cost, in this case, of financing. We're not going to have investors very long if we don't pay them dividends for being part owners of our company. We have the cash purchase of equipment. Well, equipment is a non-current asset, and it's something that our company definitely needs to be successful going forward for a long period of time. So by buying equipment, we are essentially investing in the long-term success of our business. So anything to do with a non-current asset is going to go in the investing section. The issuance of common stock is an equity account. Common stock is. And we are issuing that common stock to raise money for our activities, which means that is a source of financing for us. So common stock, anything to do with equity accounts, is always going to go in the financing section. Depreciation expense is a non-cash expenditure, which will have lowered our net income, but doesn't actually affect our cash on hand. which means when we are adjusting our net income to the cash provided by operating activities, we have to account for that depreciation. Therefore, depreciation expense, like all non-cash expenditures, is going to go in the operating section. Next, we have a gain on furniture disposal. The gain that we experience here would ultimately increase our net income for the period, but the gain doesn't increase the amount of cash that you have on hand. It's purely the difference between the book value of that asset at the time you disposed of it versus the proceeds that you got from the sale of it, which means that gain affects our net income, does not affect the cash provided by operating activities, and we therefore need to adjust for that. So gains and losses always go in the operating section as well. We have our cash proceeds from the furniture sale. Now we have furniture, which is a non-current asset, causing our cash account to change because we actually sold it and received cash for it, which means that is going to go in the investing section, just like all other non-cash or non-current assets. Next, we have the acquisition of land via notes payable. Well, land is a non-current asset. Notes payable is a piece of long-term debt. Non-current assets go in the investing section. Long-term debt goes in the financing section. Which place should we report this? And the answer to that is neither. Why? Because there's no cash actually exchanging hands within this transaction. We are acquiring the land, but we don't have to outlay cash to do it. We're taking a notes payable on our books, but we're not receiving cash at the time we sign the notes payable. We're receiving the land. So in this particular example, this is a non-cash activity. Net income is where you always start from your statement of cash flows from. It is ground zero for the statement of cash flows, which means it is going to go into our operating section. And then we have the cash purchase of treasury stock for $40,000. Treasury stock is a contra equity account, but it is still an equity account. It is stuff to do with financing. We're hoping to buy that stock now, sell it at a higher price later, so we can increase our cash flow. Which means treasury stock, like all equity accounts, is going to go in the financing section. So now that we got our grid laid out and we know our changes, we're going to be good to go to prepare our statement of cash flows. Let's start with our net income for the period. And our net income for the period, according to our information, was $35,000. We have two columns here. We have the left-hand column and the right-hand column. We're going to throw that net income into the right-hand most column. And then we need to make adjustments to the net income to convert it from the accounting income we're reporting to the actual cash that was provided by our operating activities. And my advice to everybody in the first step of this, always account for any non-cash expenditures that you would have on your income statement, which may have lowered your income but didn't actually lower your cash. And here we have depreciation expense. We recorded $21,200 of depreciation expense during the period. But that doesn't mean we had to send $21,200 worth of cash out to anybody. We just recorded the loss in value of assets that we've already paid for, which means it decreased our net income, but it did not decrease our cash. And what we should do here is add that back in. The next step is to look for any gains or losses which may have affected your net income but didn't actually affect your cash. And we have one of those right here. We have a gain on furniture disposal. We have this $1,000 gain on furniture disposal because we sold that furniture for $1,000 more than our book said it was worth at the time. But it doesn't really mean that we got an extra $1,000 in cash above the proceeds of the sale. If you see, look in the line below, we got $5,000 in proceeds. That's the actual amount of cash we received. The $1,000 that we're reporting a gain is purely a book valuation thing. It is non-cash in nature, which means we need to adjust our net income for that gain. Well, if that gain is increasing our net income, but it's not increasing our cash flow, what we should do is we should subtract it out. So we're going to subtract that gain of $1,000 from our net income when we make our adjustments. Look through to see if we have any more non-cash expenditures down here that would have to go into operating or any other gains or losses, and we do not. We've taken care of all three of the things that we already determined should go in the operating section, which means we're free to move on to all of our non-cash current assets. We're not going to report the change in cash. Why? Because that is our answer at the end. The reason that's provided for you is so you know what number you're working towards. But we do need to adjust our net income for the changes that we had in our other accounts. So what happened to accounts receivable? Accounts receivable decreased by $8,000 during the period. Well, when we adjust for our decrease in AR, a decrease in current assets is going to increase cash flow. If we have less accounts receivable, that means that more of our customers must have been paying us in cash. We have less owed money on the books, which means our cash flow has to be going up. So we're going to increase our cash flow by the amount of decrease that we had to AR. For inventory, we have $1,000 more inventory on the books. Increase in inventory of 1,000. If we have more inventory on the books, we either bought more inventory, which would have required us to spend more cash, or we are not selling as much inventory, which means we would have not brought as much cash in from sales. But in either of those instances, both of those would decrease our overall cash flow. So that increase in inventory is going to be a $1,000 decrease to our cash flow. And lastly, we had supplies with an increase of $2,000. We must have paid more to buy supplies if we have more supplies on hand, which means that increase in supplies should also be decreasing our cash flow by the same amount, which is $2,000 in this instance. So for your current asset accounts besides cash, what you're going to do is find the change, and whatever the change is, do the opposite on your statement of cash flows. If you have an increase to a current asset, it decreases cash flow. If you have a decrease to a current asset, like we do with AR, it increases cash flows. For current liabilities, you do the same. The current liabilities and cash flow work in the very same manner. So the first thing we had right here was accounts payable going up by $4,500. Well, if we had an increase in accounts payable, it's also going to increase our cash flows by that same amount. Why is that? Because if we have $4,500 more in accounts payable, we bought $4,500 more worth of stuff on account, which we didn't have to pay for, which means we have that extra $4,500 in free cash flow sitting around in our bank account. For accrued liabilities, we had a decrease of $1,500. If we had $1,500 less of, say, interest payable or salaries payable on our books, that means that we spent more cash since we didn't incur as much debt. And that means it would have less cash flow. And then lastly, we have a $400 increase in unearned revenue. We have an increase in unearned revenue. We got paid more in advance for jobs we've not done yet, but we still got paid more in advance, which means we should have more cash on hand. So that increase in unearned revenue is also going to increase our cash flows. So for the current liability section, just do the same. If it's an increase to a current liability from on your balance sheets from one period to the next, to the current period, you increase your cash flows. If it's a decrease, you decrease your cash flows. And then after you're done finding all of your non-cash expenditures that would be on your income statement, any gains or losses that you report on your income statement, the changes to your non-cash current assets, and the changes to your current liabilities, you're going to go and you're going to find the sum of all of those changes. And that is the total amount of adjustments that you need to make to net income to convert it to the cash that was actually provided by operating activities. And since this number is positive, our total amount of adjustments, we are going to add it to the net income that we had. Yes, we reported $35,000 worth of net income, but our operations actually increased our cash by $63,600 during the period. And if you think about it, it really makes sense, especially with this huge chunk of depreciation expense that we had on here. That would have driven our net income way down, but since we didn't have to transfer any cash for depreciation, our amount of cash actually provided by our normal course of operations should indeed be way, way higher. So we got through the hard section. Now we get to move on to the easier parts, starting with investing activities. And we already identified over here that the two things that need to go into investing are the two items we have related to our non-current assets. the purchase of equipment with cash, and the cash proceeds from the sale of furniture. Well, let's do the cash purchase of equipment first. If we spent, in this case, according to our numbers, $84,000 buying equipment, what would happen to our cash flow, the amount of money in our bank account? Well, if we spent $84,000, that has to be going down. So we would decrease our cash flow by $84,000 for the cash purchase of that equipment. Next up, the other item that we had that's going to go in this section is the cash proceeds from furniture sale. So we have our cash proceeds from the sale of furniture, and our cash proceeds from the sale of furniture here are listed as $5,000. We're the ones selling the item. We're the ones getting the cash, which means that has to increase our cash flow. So that's going to be a positive. And in total, our net cash used for investing activities is just going to be equal to the sum of all of these numbers that we have in the investing section. If we paid $84,000 for that equipment, but we put the $5,000 we got from the sale of furniture towards that $84,000, that means that overall we would have had to take $79,000 out of our bank account that wasn't there at the beginning of the period. So our cash used for investing activities is massively negative at $79,000. And then lastly, we have our financing activities. And in our financing activities, we have 1, 2, 3 different items we have to report. The payment of cash dividends, the issuance of common stock for cash, and the cash purchase of treasury stock. So let's just do them, I guess, right in order, the way that they're listed. We have our payment of cash dividends. We are taking money out of our company and giving it to our shareholders, our owners, which means since it's coming out of our company, it has to be decreasing our cash flow. I'm going to report that as a negative. Next up, for the financing section, we have the issuance of common stock, again for the receipt of cash. So we're going to say, call this cash proceeds from common stock issuance. If we are selling these shares of common stock to the public and the public is buying them from us, we have to be the ones getting the cash. And since we're the ones getting the cash, that means that our cash flow has to be increasing. So our cash proceeds from common stock issuance would increase our cash flow by $110,000. And the last thing that we have here is the cash purchase of treasury stock. Well, if we're purchasing the treasury stock, that means that we are taking the money out of our company and giving it to our now former shareholders to buy that stock back from them. And since we're paying to acquire something, our cash flow has to be decreasing. So this cash purchase, this cash payment, is going to decrease our cash flow by $40,000. And in total, those 3 financing activities would have led to our cash flow going up by $60,000. If we want to think about it just in the terms of these 3 things, if we raise $110,000 by selling that common stock, and then use that $110,000 to pay the $10,000 worth of dividends and buy the $40,000 worth of treasury stock, well, we have left over $60,000. But you can't do that. That's not legal. So in total, next thing we need to find our net increase or decrease in cash. So what are we going to do here? Well, we have our 3 major sections. We have our net cash from operating, our net cash used for investing, and our net cash provided by financing. Well, let's take those 3 numbers and add them together. $63,600 plus negative $79,000 plus $60,000 means we had a net increase in cash of $44,600 during the period. Are we correct? Well, we had our number to start with. So if you go back and compare the numbers for cash that you reported on the last 2 financial statements, we went from $20,000 up to $64,600. That is an increase of $44,600. So we have our number correct, and we know we can breathe a huge sigh of relief now because our statement of cash flows is set up properly and it's almost done. We got to do a couple more things. First, for the convenience of the users of our information, so they don't have to go back and look at our balance sheet, we should report our 2 cash balances that we report on our balance sheet each of the last 2 periods. So back up here, our cash in 2017 was $20,000. We're going to list that in here as the cash balance at 12/31/17. The cash balance that we had at the end of the current year when we reported was $64,600. Let's report that as well as our cash balance on 12/31/18. And now they can, without having to go back, say, yep, it went from 20 grand to 64,600. That works out. That is a net increase of 44,600. And then if we had any substantial changes to our balance sheet accounts, which came from things besides cash, we would have to report them in non-cash activities. And we had one of those, the acquisition of land via signing a notes payable. So in our non-cash activities, we would say that we acquired land by signing notes payable. And the balance of that land is $25,000. That was the value that we paid to acquire. That's how much we took out the note for. I'm going to report this number right in the right hand column because this is the only non-cash activity we have. However, if we had multiple non-cash activities that could be summed up, I would instead report it in the left hand column, all of them, and then in the bottom I would say total non-cash operating and investing activities during the period and report the sum in the right hand column.